Founded in 1999, Hazelview Investments, formerly known as Timber Creek Equities Corporation, is a Canadian-based real estate investment firm managing 9 billion Canadian dollars assets under management. We are active managers and value investors with capabilities that stretch across the entire spectrum of real estate, both public and private, as well as equity and debt. With a global perspective and on-the-ground local expertise, Hazelview employs more than 600 individuals across 19 offices in Canada, the United States, Europe, and Asia. The firm is led by Ugo Bazzari, who believes strongly in the value of the team and instills a value system that is committed to fostering the long-term growth of employees, communities, and the investments we make for our clients. Our public real estate investment strategies are supported by an experienced and proven team of real estate professionals, strategically located in key global markets including Canada, the United States, Asia, and Europe. Our comprehensive feet-on-the-ground presence allows for a deep understanding of local markets, enabling us to accurately and efficiently source, underwrite, and monitor global real estate investments. The Asian Pacific marketing continues to play an important role in our public REIT strategies. Our Hong Kong office was established in 2016 in order to focus our efforts more heavily on this large and growing REIT market. Thanks to our local presence, we are able to source, manage, and control our investments in Asia Pacific with precision and stay closely connected with projects and stakeholders. Asian stocks currently represent approximately 20% of our public real estate strategy. After an eventful year with unprecedented impacts caused by the pandemic, we believe the global economy is starting to rebound, and we are focused on finding investment opportunities in 2021 that will benefit from a recovery. We believe a suite of highly effective vaccines and therapeutics are likely to foster a return to everyday life, which in turn will positively influence residential and commercial real estate fundamentals. Some sectors will bounce back more quickly, some will take longer, and some will recover below pre-COVID levels, creating a new normal. The nuance is timing and the magnitude. COVID-19 has also created a unique opportunity in the public REIT market to own high-quality, core institutional real estate at prices that are unattainable in the private market, and office is a great example, like in Japan, Australia, and even Hong Kong. We are less positive on retail globally, but even where we feel there are opportunities in centers such as in Asia and the US that cater to necessity-based, essential retail concepts like grocery in an open-air format. We from Hazelview Investments will remain highly selective in choosing the real estate sectors and geographies where we see growth potential on the mid to long term. With interest rates at record lows, the yield spread from risk-free bonds to stabilized implied cap rates of listed global real estate companies is close to 5% in our global universe. Our forward-looking models predict annualized total return expectations of mid to high teens for the upcoming years of our global public real estate coverage, with a blended dividend yield of approximately 3.5% on a global scale. While real estate stocks in Europe in general screen less attractive than in other markets, we reckon that North America and selective Asian markets still offer pockets of solid double-digit annualized return potential. In our global allocation, we have identified 5 key secular growth investment trends that are poised to impact the world of real estate over the next 3 to 5 years that can only be accessed in size through public REIT markets. First, convergence of technology, innovation, and real estate that will further enhance the demand of data center space and cell towers. Second, e-commerce and supply chain optimization that will further highlight the importance of logistics and industrial properties. Third, growing demand for affordable residential housing, and further urbanization and the trend to smaller, more efficient spaces. Lastly, specialty property types like self-storage or social infrastructure with strong secular tailwinds. The big unknowns, but with significant recovery potential, can be found in the hotel and hospitality sector, where our allocation participates in the recovery through hotel operators, franchisors, and owners of hotels. The question to raise is, when will RevPAR levels be back to what we have seen before COVID-19? We are convinced that hotel operators need to adjust their business models to enhance profitability. Most likely, a certain portion of business travel might never come back. We expect margins to be higher next cycle than this cycle, as owners and operators turn to zero-based budgeting in order to maximize profitability at a lower level of occupancy. Further challenges occur in the office sector across the world. We believe that different cultures and work styles should impact the demand for office space in the long run. Office REITs are attractively priced, and there is a tremendous valuation gap if we consider what investors in the direct real estate market are willing to pay compared to the implied capitalization rate of certain listed office real estate companies. Within our portfolio strategies, we are mainly focusing on developed markets. However, we are pleased to see increased investment opportunities that offer access to listed property corporations in emerging markets like China or India, with significant growth potential. We remain selective in Singapore, where industrial specialists are trading at significant premiums to NAV, already pricing in accretive external growth over the next years. We do recognize that developers continue to show cheap valuations. In addition, investors can gain access to alternative markets like India through the Singaporean REIT structure, which we consider as attractive. Hong Kong finally saw an uptick in its economic growth in the third quarter of 2020, after 5 consecutive quarters of economic downturn caused by the trade war, social unrests, and COVID-19. All eyes are on the recovery of the economy and on the opening of its borders. 80% of Hong Kong's inbound tourists are from the mainland of China. Once Hong Kong can welcome visitors again, hospitality, retail, and the office market should recover substantially. In the meantime, we favor investments in the domestic data center market, which faces one of the strongest tenant demand across the region. Japan's REIT market significantly underperformed the TOPIX real estate by 7% year-to-date till mid-December 2020. Despite the complex business structures, our valuations still predict that Japanese developers are trading at attractive price levels and are well positioned to benefit from the recovery of the pandemic. We continue to believe that particularly the Japanese office market will recover faster than other global business hubs in the world, based on limited supply lined up for the next 2 years and the current vacancy rate, which is still below 5% per the end of November 2020. In Australia, many commercial asset classes might face pressure on cap rate expansion given elevated levels of incentives, pressure on rent levels, and higher vacancies. In this environment, we favor logistics as one of our preferred asset class based on further cap rate compression driven by high investor demand and continued e-commerce penetration. Worth mentioning, Australia offers unique access to specialty asset classes like self-storage and social infrastructure. The pandemic caused a further digitalization of the Western society, where IT service corporations face strong growth driven by continued end-user demand. India has turned out to be one of the most favorable locations to fulfill this IT demand. Rents are inexpensive and the pool of English-speaking talent is immense. We are convinced that continued inflow of overseas capital will flourish India's property market, including the progress of its local REIT presence. That the Chinese REIT legislation will kickstart in 2020, and we are curiously observing the evolution of the REIT investment scheme in the mainland. A strong forecasted GDP growth of 8% in 2021, further opening up of the economy, and a continued raise of the middle class bodes well for a well-recognized REIT scheme to be established in China. Encouraged by strong domestic retail consumption, we are cautious in regard of the elevated vacancy rates of above 20% in Tier 1 and Tier 2 cities. We recognize strongest expansion in the data center space with 20% annualized growth target for the next 3 years. Listed real estate companies incorporated in Asia Pacific fill approximately 1/4 of the market capitalization of the global FTSE APREA REIT Developed Index. The index is dominated by North America with over 55%, while Europe takes less than 20%. Major difference across global REIT regimes is that in Asia, most of the REITs are externally managed, while in Europe and North America, REITs are usually run by an internalized management team with incentives aligned with shareholders. As dedicated real estate investors, we promise to our institutional clients the best possible portfolio management solutions. The similar expectations do we address to companies which we consider investing in. We appreciate the implementation of modern corporate finance theory with investments that should be accretive to funds from operations, minimizing the weighted average cost of capital at sustainable leverage, and issuing fresh equity at levels above net asset value. In times where stock prices of listed property companies trade below net asset values, we encourage management teams to consider share buybacks if alternative acquisitions should be less attractive than investing in its own share capital. Major advantage of investing in REITs compared to direct property investments are based on its high liquidity with low transaction costs, global diversification opportunities across sectors and countries, daily market pricing, and finally, its transparency as a regulated vehicle. Low interest rates, changes in regulatory investment opportunities, and mispricing of REITs compared to the physical real estate market has started to attract institutional investors to increase their allocation towards REITs. The appetite for global REITs continues and is proven by the significant amount of absorbed new equity which was risen even throughout this difficult year 2020. New REIT codes in Singapore and Hong Kong will offer an enlarged toolbox for accretive growth opportunities. The establishment of new REIT regimes in emerging markets like India, Philippines and China will continue to gain long-term attraction. Environmental, social and governance characteristics have become essential for sustainable investing, not only on the REIT level, as it plays also an integral role in the underwriting, valuation and selection of our investment universe and in the investment mandate of our institutional clients. In summary, global REITs are attractively priced and offer a valuable opportunity to participate in the recovery of the pandemic, to own high-quality institutional real estate at prices that might not be available in the private market. APREA, as the leading industry association for property investments across Asia Pacific, connects investors, asset managers, property companies and service providers throughout the globe. Together with APREA, we are keen to actively influence and improve the listed real estate sector in Asia Pacific to strive for sustainable investments, attractive market growth, regulatory changes and introductions of new companies and REIT regimes across the region. The best is yet to come.